Did you know that Alphabet stock gained 58% in 2023?
So, why hasn't it grown in 2024?
And will YouTube ad revenue make it a stock to invest in shortly?
Let's get into it.
Google stock has gained only 5% so far this year,
while Nvidia has just exploded past Alphabet's $1.8 trillion market cap into third place. Why is that?
Well, aside from the fact that Nvidia is killing it in the GPU and AI markets,
it has a little something to do with the January 30th earnings report for Alphabet. The earnings per share of $24.65 for 2023 beat the average analyst estimate of $23.12. And revenue rose 23% year-over-year to $76.4 billion, surpassing the expected $74.8 billion. Sounds like good news so far, right? The only bad news was that the company's core advertising business generated $58.3 billion in revenue, up 22% from a year ago. How is this bad news?
Well, this slightly missed the analysts' projection of $58.5 billion.
As Google faced increased competition from rivals such as Facebook, Amazon, and Microsoft in the online ad market. Some investors were also worried about how the rise of generative AI will impact internet search. Because of this, Google's stock price fell 3% in after-hours trading following the earnings release. So, let's talk then about the ad revenue for the future.
Can we see any indications that it will rise soon?
Is it Google Search or YouTube that will increase the revenue?
Although Google Search may be slightly losing market share to Microsoft,
it may in a way be a good thing, considering the ongoing lawsuits against Google.
Because of its absolute domination in the search market over a long period of time.
It is being sued by consumers, states, and the Justice Department
over alleged stifling of competition and attempted domination in search online, on mobile, and inside cars, on TV, and more.
However, all of the largest tech companies typically have these type of lawsuits or similar ones that they have to deal with. And, in the end, it doesn't gravely affect them.
Plus, with Alphabet's $110 billion of cash and reserves on hand,
it has the money to pay any fines and they have the capacity to restructure, if necessary, and still make a lot of money. The expected revenue is projected to go up, just like it had previously. It's just a matter of meeting analysts' expectations.
Google Search is not Alphabet's only search engine though. Which is the second most used search engine? YouTube, of course. We all use it whether it is to find a recipe, fix a car, hear music, discover the latest viral video, or get financial news. And more. There is some debate about whether YouTube is indeed second in search. Some other analysts say it is number 3 after Google Images.
But that just cements it that parent company Alphabet really is the king of search.
Now, one thing I think that most analysts are not aware of is
that YouTube is gaining more and more viewers and the way YouTube is being viewed is changing. What do I mean by that?
YouTube used to be something you used to watch only on your mobile phone or on your laptop.
But now, it is moving into the living room.
It is no longer just used to watch small creators like me put out interesting content, but more and more it is used to watch live sports and entertainment. More like how traditional TV was watched with friends and family on a big screen.
The numbers are crazy. Around the world, people are now watching YouTube on TV for more than 1 billion hours a day. So, what's the difference going to be for the company?
Well, if more and more people are going to watch YouTube on TV,
then more and more, YouTube will start getting revenue from advertising that TV stations used to get.
Plus there is YouTube TV, which you can pay for by subscription. It has more than 8 million subscribers, that's more revenue.
And in the past year, the people who are getting most of their content on big screen from YouTube has shot up by 4 times.
Not only that, but people are watching more shorts on TV, averaging 70 billion daily views.
That is the equivalent of every person on the planet watching 9 shorts every day. So, YouTube looks promising to continue bringing in more revenue for Alphabet.
Unfortunately, on Valentine's Day though, Google stock dropped slightly, by 2.5% on news
that rival OpenAI could be planning to launch its own web search tool, not to mention their collaboration with Microsoft. OpenAI's technology has been integrated into Microsoft's Bing search engine. However, the market is being too severe, based on speculation. Don't forget that Alphabet has their own generative AI in Gemini, and it is being used to improve Google search.
So we should look at Alphabet in terms of where their revenue growth is going to come from.
And also determine if its metrics show it to be an undervalued or overvalued stock. When we look at revenue, Google Search and YouTube continued to provide growth to Alphabet during the fourth quarter of 2023. In addition, increasing demand for artificial intelligence accelerated growth in its Google Cloud service. It is just the weakness in Google's advertising technology business that is slowing advertising growth a bit. Specifically in the network segment. Advertisers will likely use non-Google ad tech platforms when they purchase non-Google properties. This has been a trend for more than 10 years, during which time non-Google network revenue for Alphabet has declined to 13% of total advertising revenue from nearly 23%.
However, as mentioned, its Google Search and YouTube properties have been a driver for growth, along with accelerated growth in the highly profitable Google Cloud service. The Google Cloud unit had its fourth consecutive profitable quarter. Its revenue growth came in at an impressive 26%.
Accelerating from Q3's revenue growth of 22%, and thus the division's operating margin surged to 9.4%. The year before it was negative. So, Google Search, YouTube, and Google Cloud are the best revenue generators for Alphabet. Now, let's look at its value proposition. Its stock closed at $141.76 on the 16th of February.
It has a P/E of 26.12 and a forward P/E of 21.93.
This suggests that the stock is undervalued at this point.
When we look at Meta,
which is a tech company that is similar and heavily relying on advertising revenue, it is trading at a higher P/E of 30 and a forward P/E of 23.53. There is no reason that Alphabet shouldn't reach at least these valuations. Indeed, if we browse the analysts' ratings from TipRanks, they currently are giving the stock a 12-month estimated forecast of $164.56 with 29 buys and 8 hold. The downside is very minimal with the lowest forecast at $141, where the stock price basically is right now.
So, the acceleration in cloud revenue growth, further monetization of YouTube and the continuing steady growth in search will likely more than offset the impact of declining network segment revenue.
If you received value from this video, please subscribe.